If the phrase tax season makes that familiar knot form in your stomach, or if
Mm.
you've ever felt just completely ground by all the financial information out there, you are definitely not alone.
No, not at all.
It's so easy to feel like you're missing out on, well, crucial opportunities.
That feeling of being overwhelmed, it's incredibly common. And honestly, it often means people are leaving significant money on the table. It can be a huge source of stress, and, it really doesn't have to be.
And that is exactly why we're doing this today. This deep dive, think of it as your shortcut to really getting tax planning.
Right.
We're pulling out the most important nuggets of knowledge, those surprising facts, and the actual insights from the sources you shared.
The goal is clarity.
Exactly. Our goal is to give you a clear roadmap, help you maximize savings, ensure, optimal financial health, and hopefully find some real peace of mind.
Mhm.
We're looking at everything from the basics, the fundamental principles, all the way to advanced strategies and, yeah, those common pitfalls to steer clear of. So have you ever wondered how you could actually turn tax season from like a source of dread into a strategic opportunity?
It's a great question.
Okay, let's unpack this. So first off, let's dive into the why. Why is tax planning so vital?
Well, at its core, it seems like it's about proactively strategizing for your future tax obligations, but always, legally.
Always legally, yes. It's an area that frankly gets overlooked a lot. And that oversight, it leads to so many missed opportunities, increased burdens.
Right, so it's like a blueprint, really, for maximum savings and just better financial health overall.
Exactly. And what's fascinating here, it's not just about compliance ticking the boxes. It's about truly optimizing your financial landscape.
Optimizing.
Yeah. And that demands foresight. It demands a strategic approach to legally minimize your tax liabilities.
Okay, so when you say optimization, what are the core benefits? What makes that foresight so crucial?
Yeah.
Well, the first big one is just financial efficiency. Smart tax planning helps you reduce your taxable income through strategic choices. Basically, making sure you don't overpay.
Which nobody wants to do.
Right. Then there's informed decision-making. Tax implications, they touch almost every major financial choice you make.
Like buying a house or investing.
Exactly. Investing, starting a business, even planning for retirement. Understanding these impacts leads to much smarter decisions down the line.
That makes perfect sense. I mean, you can't really make a truly informed choice about a big investment if you don't grasp the tax side of it, right?
Precisely. And that leads right into future readiness. Tax laws, they change. Our financial situations change too.
Constantly.
Yeah. So planning ahead prepares you to adapt, basically protecting your assets no matter what changes come your way.
Okay.
And finally, and maybe the most valued by many, is peace of mind.
Oh, definitely.
The anxiety around taxes can be just immense. Having a solid tax plan in place means you can feel genuinely secure about your financial standing.
That peace of mind is huge. I'm thinking of this example, John, a mid-level manager. He used to absolutely dread April 15th every single year.
I bet.
Then he engaged a financial advisor, and he uncovered deductions he'd completely missed. Things like, home office expenses, educational credits from professional development courses he took.
Things people often overlook.
Totally. By leveraging those, John significantly cut his taxable income. It transformed tax season from pure anxiety into, well, just a manageable process.
And John's story, it really highlights that broader impact. It goes beyond just avoiding penalties. Smart tax planning leads to maximized deductions and credits,
Right.
which translates directly into lower tax bills and, importantly, enhanced cash flow.
More money in your pocket.
Exactly, which fuels wealth creation. Less tax means more capital for investments or savings or reinvesting in a business. Proactive planning also lowers audit risk. Why? Because accurate record keeping is just fundamental to it.
Makes sense.
It also helps you align your tax strategies with your structured financial goals, whether you're saving for a house, retirement, your kids' education.
It connects everything.
It connects everything, and it's absolutely crucial for retirement preparedness, making sure your retirement accounts are set up right for both current and future tax advantages.
And speaking of retirement, that reminds me of another great example, Sarah, the freelance graphic designer.
Yes, the SEP IRA example.
Exactly. When she decided to get serious about retirement planning, her advisor suggested a SEP IRA. What she quickly realized was contributing wasn't just building her nest egg.
It also cut her current taxes.
Significantly. It reduced her current taxable income right away.
Yeah.
So it was this dual win, setting her up for future stability with that compounding growth plus immediate tax benefits.
It really shows how powerful those strategic choices can be. SEP IRAs are fantastic tools for the self-employed.
It really does. Okay, so we've established why tax planning is so important. Now let's get into the actual tools, the nuts and bolts, deductions, credits, and those really powerful tax-advantaged accounts.
Right. Let's start by maybe clarifying tax deductions versus tax credits. Because, look, they both save you money, but they work very differently.
Okay, how so?
A tax deduction, it reduces your taxable income. So you pay tax on a smaller slice of your earnings.
Got it.
Think of it like this. Income $60,000, you have $10,000 in deductions. You only pay tax on $50,000.
Okay, that's clear. Examples.
Common ones are mortgage interest for homeowners, a portion of student loan interest, and surprisingly for some, medical expenses if they exceed a certain percentage of your adjusted gross income, your AGI, usually 7.5%.
Ah, that AGI hurdle. That's a key detail many people miss, isn't it?
It really is.
I remember Lisa, a teacher. She meticulously tracked every single classroom supply she bought with her own money, every marker, every poster board.
Wow. Dedication.
Right. By itemizing those deductions, she lowered her taxable income significantly, saved hundreds of dollars. It's a perfect example of a deduction making a real, tangible difference.
Precisely. Now, tax credits, on the other hand, are even more direct. They reduce the amount of tax you actually owe, dollar for dollar.
Dollar for dollar. So a $1,000 credit cuts the bill by $1,000.
Exactly. That's why they're so powerful.
Yeah.
Common credits include the Earned Income Tax Credit, or EITC, for lower-income working families, the Child Tax Credit, which many families rely on, and various education credits like the American Opportunity Credit and the Lifetime Learning Credit, designed to help with college costs.
Right. Mark, a recent grad starting his first job, he was, well, thrilled doesn't cover it when he learned about the American Opportunity Credit.
I bet.
It directly slashed his tax burden by a pretty substantial amount in those first few years out of school, really smoothed his entry into the workforce. It just hammers home that knowing about these credits can mean serious cash back.
Absolutely. So the key takeaway here, for both deductions and credits, is you have to be active. You need to review your financial situation every year. Keep meticulous records.
Can't stress the records enough.
You really can't. This ensures you claim everything you're entitled to. Don't leave money on the table for the IRS.
Okay, so deductions, lower income, credits lower the tax bill. What about these tax-advantaged accounts? You said they're game changers.
Oh, they really are. Think of them as special financial vehicles. They either let you defer taxes until later, or, even better sometimes, allow your money to grow completely tax-free.
Okay, break that down. Let's start with retirement.
Right. In retirement accounts, you've got your traditional IRAs and 401ks. These let you contribute pre-tax dollars, which lowers your current taxable income right now.
Immediate benefit.
Immediate benefit.
Yeah.
Then your investments grow tax-deferred until you withdraw them in retirement. Now, the flip side is Roth IRAs and Roth 401k.
Those are after tax, right?
Correct. You contribute money you've already paid taxes on. But here's the kicker. Qualified withdrawals in retirement are entirely tax-free.
Tax-free growth and tax-free withdrawals.
Exactly. This is particularly great for, say, younger professionals who expect to be in a higher tax bracket later in life. Pay the tax now while your rate is lower.
Smart. And remember Sarah, the graphic designer, her SEP IRA.
Yes, the SEP, or Simplified Employee Pension. It's an amazing option specifically for self-employed folks and small business owners. It lets them make really significant tax-deductible contributions, much higher limits than traditional IRAs sometimes.
Good for freelancers to know.
Definitely. Then there are health accounts, specifically health savings accounts, or HSAs. These are available if you have a high-deductible health plan.
The HDHPs.
Right. Contributions are pre-tax. The funds grow tax-free. And withdrawals for qualified medical expenses are also tax-free.
Wait, pre-tax in, tax-free growth, tax-free out for medical?
That's the triple tax advantage. It's incredibly powerful for managing healthcare costs now and in retirement.
Wow. Okay. And education.
For education accounts, the big one is the 529 College Savings Plan. Contributions are generally after tax at the federal level. But the earnings grow tax-free, and withdrawals for qualified educational expenses, tuition, fees, room and board, even some supplies, are also tax-free. Plus, many states offer a state tax deduction or credit for contributions.
Another potential double benefit there.
Absolutely.
So, okay, let's boil it down. What does all this mean for your bottom line for the listener?
Well, it means understanding and actually using these components, deductions, credits, tax-advantaged accounts, is absolutely crucial. It's how you lower your overall tax liability, how you boost your savings potential, and how you really support your long-term financial goals. It's putting the tools to work.
Okay, fundamentals covered. That's the toolkit. But the real magic, it seems, often happens when you start thinking more strategically, right? Let's explore some of those more specific, advanced tax planning techniques, the kind that can ease current burdens, but also really position you for significant future growth.
Exactly. This is where things like income deferral techniques become really interesting. The basic idea is to postpone when you actually recognize income on your tax return.
Why would you want to do that?
Well, it reduces your current tax obligation. It's particularly powerful if you think you might be in a lower tax bracket in the future. Maybe you're planning to retire or take a sabbatical or change careers.
Oh, okay.
Timing matters.
Timing is key. We already touched on retirement accounts like 401ks and traditional IRAs. Maxing out those contributions is a prime example of income deferral. You get the tax break now, and the money grows untaxed until later.
Right, like John, the software engineer example, he maxed out his 401k. That move didn't just cut his tax bill that year.
It built a significant nest egg.
Exactly. A substantial retirement fund growing year after year without being hit by annual taxes. That's smart deferral paying off twice.
Absolutely. Other options include deferred compensation plans, often available to high earners. They can arrange to delay receiving a portion of their salary or bonus.
Like Anna deferring her bonus. Precisely. Maybe she defers it until the following year when she expects lower income, and thus a lower tax rate on that bonus. And health savings accounts, HSAs, as we just discussed, contributing pre-tax dollars, now defers the tax until you potentially use it, tax-free, for medical costs later.
Okay. What about real estate?
Yes. A really powerful, though complex, deferral tool for real estate investors is the 1031 exchange. This allows you to sell an investment property and defer paying capital gains taxes, potentially indefinitely, as long as you reinvest those proceeds into another like-kind investment property within a specific time frame.
Like kind being the key phrase there.
Very key. It's quite specific. You could exchange, say, raw land for an apartment building, but you couldn't exchange that land for, like, heavy construction machinery. It has to be real estate for real estate.
Interesting nuance. Okay, income deferral. What else?
Next up is capital gains management. This focuses on the profit you make when you sell assets, things like stocks, bonds, real estate.
The money you make on your investments.
Exactly. And the crucial distinction here, absolutely crucial, is short-term versus long-term gains.
Okay, what's the difference?
Assets held for 1 year or less. That sale results in a short-term gain. And those are taxed at your ordinary income rate, which can be pretty high depending on your bracket.
Ouch.
Yeah. But assets held for more than 1 year, that's a long-term gain. And these benefit from significantly reduced tax rates, much lower than ordinary income rates for most people.
So the goal is clearly long-term holding.
Generally, yes, from a tax perspective, aim for long-term.
I remember Ryan, the investor example, he learned that lesson by just holding his stocks for over a year, resisting that urge to sell quickly.
Patience paid off.
Big time. He paid dramatically less in taxes on his earnings. It's really a powerful lesson in patience meeting strategy, isn't it?
It truly is. Another slightly more sophisticated technique is offsetting gains with losses, often called tax loss harvesting.
Harvesting losses. Sounds counterintuitive.
Well, it allows investors to use capital losses, from investments that didn't perform well, to offset or cancel out taxable income from capital gains.
Ah, so you use the losers to reduce the tax on the winners.
Exactly. Maria, for instance, maybe she strategically sold an underperforming tech stock in the same year she sold another investment for a big profit. The loss from the tech stock could reduce or even eliminate the taxable gain from the other sale.
Clever.
It requires careful tracking, but yes. Also, just simple. Timing the sale of assets is important. Beyond just holding for long term, be mindful of when you sell.
Yeah.
A very large gain could potentially push you into a higher tax bracket for that year.
Good point. Any other big strategies here?
One more, less common but potentially very powerful, involves investing in opportunity zones. These are specific geographic areas designated for economic development.
I've heard of those.
Yeah. By reinvesting capital gains from any source into qualified opportunity funds, which then invest in businesses or properties within these zones, you can defer the tax on those original gains. And potentially, if you hold the opportunity zone investment long enough, you might even eliminate the tax on the appreciation of that investment.
Wow, so deferral and potential elimination, plus community investment.
Correct. It's designed to spur economic growth in underserved areas while offering significant tax incentives. Complex rules apply, of course.
Of course. But understanding these kinds of strategies, income deferral, capital gains management, tax loss harvesting, opportunity zones, it feels like they can really result in considerable financial benefits.
Absolutely. They really do shift tax season from just compliance to a genuine strategic opportunity for growth.
Okay, so we've talked about all the great strategies and benefits, but let's be real, there's always a flip side, right? Common pitfalls, mistakes that can completely undermine even the best financial plans.
Unfortunately, yes.
So let's talk about navigating that minefield. What are the common tax mistakes? And more importantly, how do you avoid them?
One of the absolute most prevalent, yet often easily avoidable mistakes is simply overlooking deductions.
Just missing them.
Just missing them.
Yeah.
Which means you're essentially paying more taxes than you legally need to. Happens all the time.
What kind of deductions get missed most often?
Well, the home office deduction is a big one, especially now with so many people working remotely, at least part-time. Charitable contributions to people often don't keep good records, especially for smaller cash donations or things they donate, like clothes or furniture.
Need those receipts?
Need the receipts or proper documentation. And remember, medical expenses. They're deductible only if they exceed that 7.5% AGI threshold. But many people don't even track them to see if they qualify. Education expenses, certain work-related expenses, the list goes on.
I'm thinking of another Sarah, not our graphic designer, but a remote worker. She had no idea about home office deductions, just used her spare room, didn't track square footage, didn't track utility percentages, nothing. Right.
Then she talked to a tax advisor who pointed it out. Realized it could have saved her thousands over the years she'd been working from home. It just shows how an oversight can be really costly.
It really does. So how do you avoid this? The best defense is a good offense. Stay organized. Keep thorough records throughout the entire year, not just scrambling in March or April.
Don't wait till the last minute.
Please don't. Consult resources, use reliable tax software. Check the IRS website, or, ideally, consult a qualified professional. And always try to educate yourself on new tax laws or changes that might affect you. Tax rules aren't static.
Good advice. Okay, what's another big mistake?
Oh, a huge one. Missing deadlines. This is almost guaranteed to lead to penalties, interest charges, and sometimes missed opportunities, too.
The obvious one is April 15th for filing personal returns. Right?
That's the big one, yes. Missing it without an extension triggers failure to file penalties, which can be substantial. But there are others. For self-employed individuals or those with significant non-wage income, estimated tax payments are due quarterly.
April, June, September, January. That's generally it. April 15th, June 15th, September 15th, and January 15th of the next year. Miss those, and you face underpayment penalties.
Ouch.
And here's one people often forget. Contributions to a traditional or Roth IRA for a specific tax year. You actually have until the tax filing deadline, usually April 15th of the following year, to make that contribution.
So you can contribute for 2024 up until April 15th, 2025.
Exactly. But if you miss that April 15th deadline, you lose the chance to make that contribution for the previous year entirely. That's a missed opportunity for tax savings or tax-free growth.
Wow, okay. I know Mike, the small business owner example, he learned this the hard way. Got so wrapped up in the day-to-day.
Easy to do.
Totally. He'd just lose track and blow past filing deadlines. The penalties and the interest that piled up really put a strain on his business finances.
It adds up fast.
He finally implemented a really rigorous calendar reminder system for everything tax-related after that.
That's the way to do it. Strategies for meeting deadlines. Create a tax calendar. Mark all the key dates filing, estimated payments, contribution deadlines. Set up alerts on your phone, your computer, whatever works. And if you're overwhelmed or unsure, honestly, seek professional help. A good tax pro manages this as part of their service.
It's a small investment for potentially big savings and peace of mind.
Significant peace of mind.
So bottom line for avoiding mistakes, stay organized, stay informed, meet your deadlines. Taking those proactive steps really can transform the whole tax experience, can't it?
Absolutely. From a chaotic scramble into something far more manageable and, frankly, financially favorable.
Now, sometimes, despite our best efforts to stay organized and informed, things just get complicated.
Life happens, finances get
Yeah,
complex.
exactly. And that's when knowing when to call in the cavalry, when to leverage a tax professional becomes really key. And also, how do you choose the right one?
It's a great point. And what's really important to understand is that engaging a tax advisor isn't just for, huge corporations or the super wealthy.
Right. It's for regular people, too.
Absolutely. It can save immense time, minimize stress, and often lead to significantly better financial outcomes for many individuals and small business owners.
Yeah.
So when should you consider it? Definitely if you have complex financial situations.
Like what? Multiple jobs?
Multiple income sources, yeah.
Uh-huh.
Maybe investments, rental properties, a side business that's growing. Anything beyond a simple W-2 can add layers of complexity.
That reminds me of Leslie, the freelance writer. She juggled income from like 5 different platforms. Initially, she thought, I got this.
Famous last words sometimes.
Right. But as her income streams grew and got more varied, she felt completely swamped. A tax pro helped her categorize everything correctly, find deductions she'd never even thought of.
And likely saved her money and hassle.
Dramatically boosted her savings, yeah.
You should also strongly consider advice during major life changes. Things like getting married, getting divorced, having a child, inheriting wealth, even retiring. These events almost always change your tax picture significantly.
Jake, the new parent example, he consulted a pro just to understand the child tax credit properly and figure out how to adjust finances for all the new baby expenses.
Smart move. Business ownership, too. That brings a whole unique set of challenges. Navigating write-offs, understanding self-employment taxes, choosing the right business structure. An advisor is almost essential there.
Miriam, starting her catering business, she quickly realized tax regulations were way more complex than she'd bargained for.
Very common for new entrepreneurs.
Enlisting an advisor gave her clarity on expense tracking, but also introduced her to things like the qualified business income deduction, the QBI deduction.
Which can be a huge tax saver for pass-through businesses.
Absolutely, saved her a fortune.
And definitely, if you find yourself facing tax debt or audit risk, getting professional help is critical. Don't try to navigate an IRS audit alone if you can help it.
Right. Robert, who got that audit notice, he said having his tax advisor handle the communication and representation made a super stressful situation feel manageable.
It provides a buffer and expertise. Finally, just keeping up with upcoming tax law changes. Laws change, credits expire, new rules come in. A good professional stays on top of that and advises you on how it impacts your situation.
Okay, so lots of reasons to seek help. How do you choose the right professional? They're not all the same, are they?
Not at all. First, understand your needs. What's your situation? Are you a freelancer? Small business owner? Complex investments? Simple return? Your needs dictate the type of expertise required.
Makes sense.
Then, look at expertise and credentials. There are different types. CPAs, certified public accountants, have broad accounting and tax knowledge, often good for businesses or complex individual returns. Enrolled agents, EAs, are licensed directly by the IRS and specialize specifically in taxation, including representing taxpayers before the IRS. They're often excellent for audits.
DEIs focus just on tax.
Primarily, yes. Then you have tax attorneys, who are lawyers specializing in tax law. They're best for very complex legal tax matters, disputes, or tax court issues.
Okay, CPA, EA, tax attorney, got it.
Always seek recommendations. Ask friends, colleagues, other business owners. Check online reviews, but take them with a grain of salt. Personal referrals are often best.
Good point.
And really important, evaluate communication and support. Do they seem approachable? Are they asking questions about your goals? Are they responsive? Ideally, you want someone available year-round, not just during tax season.
Not just a tax preparer, but an advisor.
Exactly. And finally, critically, understand fee structures up front. How do they charge? Hourly. Flat fee per return. A percentage of the refund. Be cautious with that one. Get clarity before you engage them. No surprises.
Transparency is key. So really, it sounds like finding that right balance, doing your own learning, but knowing when to bring in professional support, that's what truly enhances financial health and brings that peace of mind we talked about.
That's the sweet spot. Empower yourself with knowledge, but don't be afraid to leverage expertise when you need it.
All right, we've covered the why, the how, the pitfalls, the professionals. But it's one thing to talk strategy, isn't it? What's truly fascinating, I think, is seeing how this all plays out in real life.
The tangible results.
Exactly. The actual savings, the positive impact these strategies can have. Let's look at some real-world success stories.
Well, these.
First, let's take the Jones family and the child tax credit. This was a household, 2 kids, combined income around $75,000. Initially, they just filed their taxes without really digging into the child tax credit details.
Maybe just use standard software, didn't explore fully.
Could be. Then they consulted a tax advisor who pointed out they qualified for a full $2,000 per child credit at that time. The advisor also helped them adjust their W-4 withholding with their employers.
Ah, so they got the money back throughout the year, not just at tax time.
Exactly. The net result was a direct tax saving of $4,000 for the year. And they didn't just fritter it away, they smartly allocated it to savings for family vacations and started college funds.
That's a tangible impact.
Yeah.
$4,000 makes a real difference to a family budget.
Huge difference. Okay, then we have Tom's investment strategy. Tom was an avid investor, had multiple rental properties, and was facing some pretty substantial capital gains taxes from sales.
A common issue for successful real estate investors.
Right. His tax advisor helped him expertly navigate a 1031 exchange. He sold a property, rolled the proceeds into another like-kind property,
Preferring all that capital gains tax?
deferred it completely for the time being. He also, in the same year, used tax loss harvesting with some underperforming stocks he held.
Combining strategies. Smart.
Very smart. The combined effect saved him literally tens of thousands in immediate tax liability. It preserved his cash flow, allowing him to reinvest in better performing properties and keep his investment momentum going.
That's advanced planning in action, really maximizing after-tax returns.
Absolutely. And let's revisit Sarah, our freelance graphic designer. Remember, she was feeling overwhelmed juggling clients and figuring out self-employment taxes.
Right, the SEP IRA wasn't her only move.
No. After a thorough review with her tax pro, Sarah uncovered a whole range of legitimate business deductions she'd been missing.
Right.
Home office expenses, prorated utilities, part of her internet bill, client meals where business was discussed, professional development courses related to graphic design, software subscriptions.
All legitimate business costs.
Totally. The advisor also helped her set up a system to automatically set aside a percentage of every payment she received for her quarterly estimated taxes.
Crucial for avoiding underpayment penalties.
Definitely. By claiming all those newly found deductions, Sarah reduced her taxable income by nearly $10,000 that year.
Wow, 10 grand.
Yeah, which didn't just lower her tax bill significantly, it freed up cash flow, money she could reinvest in her business, new equipment, marketing, and bolster her own personal savings.
These stories, they really drive home the impact on financial wellness, don't they? It goes so much deeper than just the dollar amount saved on taxes.
How so? What are those broader benefits?
Well, first, there's the obvious increased cash flow. Like Sarah experienced, having more money available gives you greater control over your financial present, more breathing room.
Right, less month-to-month stress.
Exactly. Which leads to enhanced financial stability. You can build or strengthen your emergency fund, pay down debt faster, like the Jones family saving for goals. It creates a stronger foundation.
Makes sense.
It also fosters proactive tax management. Once you start planning, it becomes a habit. You're thinking ahead, setting the stage for much better future financial planning, not just reacting once a year.
It changes your mindset.
It really does.
Yeah.
And crucially, it brings reduced stress and anxiety. Just understanding your tax situation, knowing you have a plan, knowing you're claiming what you should be, that lifts a huge weight from many people.
That peace of mind we mentioned earlier.
That peace of mind. And perhaps the most significant long-term benefit is the increased knowledge and empowerment. Going through this process, working with an advisor, or even just educating yourself, builds lifelong financial literacy. It equips you to make confident, informed financial decisions across the board for years to come.
That's so true. It becomes clear then that tax planning isn't just about, compliance or filing a form. It's a really powerful, often underestimated tool for building a genuinely secure financial future.
Couldn't agree more.
So we've really covered a lot today. We've unpacked how strategic tax planning using deductions, credits, those tax-advantaged accounts, thinking about income deferral, managing capital gains, and knowing when to call in a pro can fundamentally transform how you manage your finances.
It really pulls all those threads together.
Yeah. And if we connect all these pieces, look at the bigger picture, it's so clear that tax planning isn't just about saving a few bucks this year. It's about long-term strategy.
Absolutely, which I think raises a really important question for you, the listener, to consider. How might actively engaging with your tax strategy, starting now, empower your financial potential? Not just for yourself today, but potentially. How could it help build a lasting financial foundation, maybe even a legacy for future generations?
That's a powerful thought. Moving beyond the immediate tax bill to the long-term impact.
Precisely. Think bigger picture.
Definitely something to chew on. Consider these insights as you navigate your own financial journey.